Alright, in this session we're going to continue our discussion of beta. So we're going to walk through this session. What I want you to be aware of, there's two Excel applications, number 6 and number 7. Number 6, I give you everything you need, the historical beta, the revenue sensitivity, I give you everything you need in the problem. And then in Excel application 7, you're going to pick your own company, a company that has at least 10 years of history, probably need more than 10 years, but at least 10 years. And you're going to walk through this same process: revenue sensitivity, financial leverage, operating leverage, and then historical rolling. I'm going to do the historical rolling. I think in this session we should have enough time. I got the internet back, so I should be able to. So this video does a 3-year rolling. We are actually going to do a 5-year because that's what Yahoo Finance does now, and you'll see why it helps to do the same process as Yahoo Finance. And again, I don't know why they keep switching their process. So I'm going to do this entire number 7 for Walmart. So you can't do Walmart, you've got to pick another company, but you'll have this as backup. And this video still works, it's just you do 5 years instead of 3. If you do yours based on 3 years, I don't count off for that, that's fine. It's just you won't have the check digit. So in a previous session, we worked part of problem 1 on the weighted average cost of capital, and we put it over in Excel. I'll have to start all over again in Excel. I may not do it exactly the same way I did it last time, but that's fine. So we at least got the cost of capital for debt, but we had to stop to do the cost of capital for equity because we had to cover beta. So today we're going to cover beta. Let me again walk you through the steps in more detail this time though. So to figure out the beta for a company, you want to know how sensitive is this company to the economy, to interest rates, inflation. So we're trying to give a sense of what this company is all about. And the first thing we ask is the revenue of this firm. How sensitive is it to the overall economy? And we're going to separate companies into two types, cyclical and defensive. You might, when you pick a company for Excel application 7, if you're worried about this distinction between a cyclical and defensive company, then I would recommend you pick an obvious one. Tiffany's may not work anymore because they're going through a merger, but Ford would work. Nordstrom's is very interesting right now. United Airlines, two firms that are really struggling right now because of the coronavirus. Are defensive companies, something like Dollar General, or you can't do Walmart, but Dollar General. You can't do Family Dollar because they got bought out, but there are other companies out there that would fall in that category. Kroger's would fit. And so what you're trying to do is figure out, is your firm highly sensitive to the economy? Does it sell durable goods? Does it sell leisure products, consumer discretionary products? That means its beta is greater than 1. This is entirely a subjective analysis. There are things you could do to somewhat test it, but it's essentially a subjective analysis. And then, is your firm defensive? Do they sell something that we consider a consumer staple? Could be grocery stores. Healthcare tends to be in that category. Even though healthcare can be expensive, most people have health insurance, and so they're somewhat insensitive to the price and to the economic impacts. If you break your leg, you're going to do whatever it takes to get it fixed. Utilities tend to be a low beta type of company. So that's the first thing you do. Just all I need in an Excel application is just a few words saying I believe this is a cyclical company because it sells a durable product or whatever. The next section you're going to handle is the leverage of the firm. Operating leverage and financial leverage. Operating leverage is how much fixed costs the firm has in its cost structure. The more fixed costs it has, the more volatile it is, because as revenues increase, say revenues increase 5%, net income will increase a lot more than 5% because they have fixed costs. As revenues fall, if revenues fall 5%, the earnings of this firm will fall a whole lot more than 5% because of all the fixed costs. So let's talk about a firm that has salaried labor. That's a fixed cost, so that should give them a higher beta, versus a firm, say like Jack in the Box or Domino's Pizza. They have hourly workers, That makes them more flexible. They can cut their hours and cut their costs. Right now with the coronavirus, extremely important. Restaurants are definitely laying people off. So their revenues are dropping dramatically, but their costs are also dropping off. Another issue is unionized workforce. Any unionized workforce like Ford or Boeing, that is going to give them some fixed costs that they just cannot handle when the economy comes down. If a firm has a lot of property, plant, and equipment, that gives them a high beta because fixed cost is a very fixed cost. A firm whose product has very elastic demand, that is, if they increase their prices 5%, the volumes that they sell will fall a lot more than 5%. So hopefully you've had price elasticity in your economics class. It just talks about how sensitive a firm's volumes are, how much they sell versus their price changes. So if a firm increases their prices 5% and their volumes fall 10%, that is very elastic demand. That is going to make them much more volatile, give them higher betas. Another firm, like a firm that sells cigarettes, like Philip Morris, they tend to have very inelastic demand for their product. They can raise their prices, especially as governments impose more and more taxes. It does cause the price of their product to go up, but the demand tends to be inelastic, so that tends to protect their gross margins, and they tend not to be that volatile. A firm with heavy research and development. So energy companies, pharmaceuticals. Pharmaceuticals tend to be lower beta companies, but they do have some large fixed costs. They have salaried workforces, and they have a lot of research and development. That's offset from the fact that they're defensive companies, but they do have an opportunity. So you can see how the two can somewhat contradict with each other. We generally say if a firm is defensive, its beta will be below 1, but if it has a lot of operating leverage, that will push them up closer to 1. Or you might have a firm that's cyclical, but they have low operating leverage, so the cyclical makes their beta greater than 1, but the fact that they have very low operating leverage will push their beta back closer to 1. It probably won't push it below 1. Energy exploration, that's a lot like research and development. Firms like Nike that have very high marketing budgets that they have to spend every year no matter what, that tends to raise their beta somewhat as well. So firms with high elasticity of demand will have very volatile gross margins, and firms with high fixed costs will have very high net margins. All right, and I'm going to show you how to assess that. This is really key, is how volatile are their net margins, because I will give you a file that will show you that you can use with Excel application 7. And I actually want the table from Excel from this file to be part of your Excel application 7. The third thing we look at is financial leverage, and that's pretty easy. It's just looking at how much debt do they have. Do they have more debt than the average firm? That's going to raise their beta. So right now, Kroger's is a good example. Kroger's is definitely a defensive company. Their beta would normally be 0.5, 0.6, but the fact that they have very high debt right now will probably push their beta up to 0.7 or 0.8. It won't push it above 1, but definitely push it higher. And then number 4 is, let's get some historical perspective. So again, I say 3-year, but we're switching this to 5-year just because Yahoo changed to 5 years. I essentially try to emulate Yahoo so you have them as a backup to see if you've actually got the right answer. So let's walk through this with Walmart. All right, so your Excel application number 7, you pick a company. I'm picking Walmart. So I'll actually work with Walmart. So revenue sensitivity, I don't need much. I'm just going to say Walmart is clearly a defensive company, and hopefully I can type a little better, as it sells many consumer staples, not everything. They do sell flat screen TVs and other things, but the bulk of their sales are lower cost items, and they are a discount store. So people go here when they're worried about prices, they're worried about losing their jobs. So this is below beta firm. Now let's look at their financial leverage and operating leverage. So what you want to do here is I created a file in Blackboard. It's called Bloomberg Data to Determine Beta. It's under miscellaneous files. So if you look at under miscellaneous files for the class, you will find this Bloomberg Data to Determine Beta. So here's the miscellaneous files. And you just go down the page. It's pretty close to the bottom. Bloomberg data determine beta. It's the 1, 2, 3, 4, 5th file from the bottom. When you load that file, now I have to warn you, this is entirely a Professor Sweet theory. I think there's a lot of credence to it. I've had some students say they think they may have seen other professors do something similarly. But what I've done is I brought in some data from the S&P 500. Remember, when we do beta, it's really against the market, and we consider the S&P 500 stock index. It's the index of 500 large companies in the United States. That's our basis for determining beta. Right now I have Costco loaded, so I'm just going to hit the equal sign. When you hit the equal sign, you go to the second page, not the third page, but the second page. And it shows all these companies alphabetical order by their ticker. You have to know the ticker for your firm. I'm going to go down to the W's, and I'm going to find Walmart. Getting close. This is a lot more than the S&P 500 here. This is actually the Russell 3000, so there are 3,000 companies in here, but you can still use it. The reason I use the Russell 3000 is so you have more choices. So I just click, do equal, and click on my ticker. So you make sure you have the equal sign first, and so it brings up Walmart. And when I bring up Walmart, it brings up all of Walmart's data. So let's look at the margins and the financial leverage. So what I'm going to do is I'm going to take these three tables. I'm going to highlight them. I'm going to do Control-C to copy, go back to the Excel application. So this is an application you can do in Word. I'm going to paste this as a bitmap. So now I have these three tables in here. I'll shrink it down a little bit just so I can see it a little bit better. And so at financial leverage, all right, so my first one, you need to, so it's a discount source, so I'm going to say beta below 1. All right. Then I'll look at financial leverage. I'm going to say their financial. Yeah, I can't type. Financial leverage is slightly below that of the stock market. How do I know that? Well, you look at the S&P 500, the median for the S&P 500 is a debt to equity of 72% or 71.88%. Walmart is 52.52%, which is 38% ranked. So I'm going to say debt to equity of 52.52% versus 71.88% for the market. This table is a little bit off. It says the S&P 500, but it's actually the Russell 3000, but that's fine. Don't worry about that. So let's see. That confirms beta below 1. It may not push my beta much lower than what I was going to use. Usually for Walmart, I use a beta somewhere around 0.7, 0.8. All right, so operating leverage. You can ignore gross margin entirely if you want to, but really to me gross margin is, and this is not gross margin itself. Be real careful when you write this. This is the standard deviation of gross margin, is how volatile is this gross margin. And what I want to look here is how sensitive are the customers of this company to price changes. I'm arguing that if the standard deviation of their gross margin is low, that they have very inelastic demand for their product. You can see the average company in the market has a standard deviation of their gross margin of 3.81%. You can see Walmart is much lower than that at 1.21%. Net margins is where you want to focus, though. The typical firm in the stock market has a net margin standard deviation of 6.25%. Walmart is very, very low at 0.51%. So I'm going to say very low operating leverage due to, I'm going to put my assumption here. If you can guess on this, I'm going to have hourly labor and very low standard deviation of net margin. Make sure you say it's a low standard deviation of net margin or a high standard deviation of net margin. Don't say it's low net margin. It's not the net margin that's low, it's the standard deviation. So you want to bring this chart in. You can ignore gross margin if you want to, but if you want to bring that into your discussion, that'd be great. All right, so we've got those two pieces in. We just got one last one to go, and that's the history. So you have to create your own history. That's the last thing in here. So the historical, how do we do that? All right, so we've talked about revenue sensitivity. We're below 1. Financial leverage, still below 1. Net margin, still confirms. Beta, and here we're going to say well below 1. Here's where I'm going to guess. I'm going to say 0.7 is my assumption, but let's look at history. See if this history confirmed that a 0.7 beta for Walmart makes sense. So here, what you do here is you go into Yahoo Finance, and in Yahoo Finance you bring in Walmart. When you click on historical data, and when you click on historical data, you want to change the time period to the maximum, and take note of how far back you go. You can see Walmart when I click maximum, so you click on here and select maximum. When I select maximum, Walmart goes back to August 24th, 1972. Reason that is important, when we bring the stock market, we want to start the month right before that. So if Walmart's data starts at August 24th, 1972, we want to do, when we do the overall stock market, we want to start at 7/31/1972. And the other thing you have to check is frequency. On frequency, it will come as daily. You want to click on this and change it to monthly. Click the apply button. After you click the apply button, click download. You'll do the same thing with the S&P 500. When you go into Yahoo Finance, the S&P 500 is one of the choices. I will warn you, if you do this right before market opens, they won't have the S&P 500. They have the futures. So you might want to take note of this ticker. It's Shift 6 GSPC, and you can, if you select that, it will bring up the S&P 500. If this says S&P 500 futures, you need to do the caret or Shift 6 GSPC. And you can see here I went back to July 31st. I clicked the 31st, but it changed it to the 30th, probably because the 31st was a Saturday. And then I did monthly and I applied. So here I have these two Excel spreadsheets. Here's Walmart's data all the way back to 1972, and I've got the market back to 1972. For the market, I'm going to delete everything. The only column you need is adjusted close. So I'm going to delete every column except for adjusted close. Get rid of the volume. Go over to Walmart and do the exact same thing. Get rid of every column except for adjusted close. When it comes in, it's possible this column will be too narrow. So just click on the column and double click. See that line that you get there? Double click on that. You have the adjusted close is all you need. I'm going to delete everything except for adjusted close. I'm going to go back to the S&P 500 and take its date and its adjusted close and hit the shift button and hit the control button with the shift button still down. Control shift and hit the down arrow. Then let up on control and shift and on the arrow and just type control C so you copy it. I'm going to take that back over to the Walmart, and I'm going to paste those dates and the adjusted close, and then I'm going to click on the first date, hit my control, not control shift, but just control, and hit the down arrow, and I'm off for some reason. Oh, because I'm sorry, I put it in the wrong row. So it lines up. Make sure you start on the right row and make sure you end on the right row. Now, because I did this, I was still in the month of March. Now, you might do this during the month of April. If you do it during the month of April, you want to get rid of the month of April. Because I'm still in the month of March, I don't have a full month of March. I'm going to delete the month of March. Go back up to the top. I no longer need column C because I just wanted to make sure I had the dates lined up. So I'm going to put Walmart at the top here, and you can just do S&P 500 there. I got my prices, and these are adjusted close. The reason we're using adjusted close, Walmart's stock price wasn't trading at 2 cents back in 1972. What this adjusted close does is adjust for whenever Walmart pays a dividend, and we won't get into that in this class. We get into my investment class, but the dividend, when Walmart pays a dividend, it distorts the price for Walmart. So the adjusted close, adjust that price so it doesn't get distorted by dividends. Now what we're going to do is I'm going to take those two titles, I'm going to copy them over, and I'm going to do what's called a holding period return. Holding period return is you just do equal, open parentheses, you click on Walmart stock price for the current month, divided by Walmart stock price for the previous month, close parentheses, minus 1. Okay, and I'll put that off to the side so that you can see it. I'm going to change that to a percent by hitting the percent button. And then now I can just copy that over to the S&P 500. All right, so you need that formula, and then you can copy it over to do the same thing for column C. Then you highlight those two columns and then go get that little box at the corner and just double click on that to copy it down. And now we're going to do a rolling 5-year, remember we're switching to 5-year, beta. So I got to find 5 years. So let me find 5 years. I'll do 1 and then I'll do 1 plus 1. So I'll take that and add 1. I'm going to copy that down about 60 rows or so. For 5 years times 12 months is 60 months. So I want to go down to month 60. There's month 60. So that's what I need. So we're going to start right there. So we're going to put our formula in right here. The formula for beta is equal slope, open parentheses, go over 2, there's where Walmart is, do Control Shift up, make sure you only have the returns, don't go all the way up to D1, go up to where the first return is, comma, come over 1 for the S&P 500, Control Shift up, close parentheses, hit enter, and that is the beta for Walmart for those 5 years. I'll copy this over to the side so you can see it. Make sure on slope you have to have your company first. My company Walmart is in column D, and then the market. If you do it backwards, it will give you bad data. Now I can just copy this down all the way down. Now I'm going to get rid of these dates. I mean this plus 1 here, so I'm just going to Control Shift and hit delete and get rid of that. So now I have the rolling beta. I want to do the median, the 90th percentile, and the 10th percentile. So I'm going to type up here 0.5, 0.9, and 0.1. And I'm going to use the percentile function. To do that, I'll do equal percentile, open parentheses, and do the entire rolling beta all the way down. You want to put a $sign on the rows. I'm sorry. You want to do a $sign on the columns. We always want it to be column F. And at the very end, do comma, and you have to come all the way back up, comma, and then the 0.5, close parentheses, and hit enter. I'll copy this over to the side. So there's that one, and then you can just copy that over to the other two. And I recommend on beta you just go out 2 decimal places. And so there's our beta. And what you want to do then in the next row is do plus the one that's up above, and then you can just copy that over. So if I put the formula over to the side and only put it once, that means the other columns you're just copying it over. So you just want to do plus the one up above, because it's the same number down. The median is the same all the way down, and then highlight those 3 and copy them all the way down. So now we have our graph. So what we're going to do is we're going to create, the data for our graph. We're going to create a graph. This is what you need to put into your paper. I'm going to go on the first rolling 5-year beta. I'm going to hit Control Shift, I'm going to hit Shift, go over 4, then I'm going to do Control Shift and come down. So I have all of this data loaded. I'm then going to insert. When I hit this insert button, I get the choice of graphs. I'm going to use a line graph, the very first line graph. I'm going to then right click on the graph and do select data. And what I want to do on the very first one is edit this first one for the name, and this is the rolling 5-year beta. Click OK. Click on the second one. The second one, you edit that. That is the median. Click on the third one. That is the 90th percentile, if I can spell that. Then click on the last one, and it's the 10th percentile. And say OK. And then the last thing you have to do, so you need to change the names of these, and then over here on the horizontal axis label, hit the edit button and go over to the dates, the same place you started your graph. Go over to the dates, then do Control Shift down and say OK. And you've got your graph. The only thing we're going to switch here is I'm going to click on the dates and do Format Axis. If you're on a Mac, I'm sorry, Macs are a little tricky. If you're having a lot of trouble with a Mac, I won't, let me know when you submit it that you had some trouble with the Mac and just you did the best you could. You should try to learn it on the Mac because it is important. So here I change it to years. Over here on the right it says add, so that gives me years. I'm going to create the chart that's going to do Walmart rolling 5-year beta using monthly data. So there's my graph. I'm going to take that graph and I'm going to copy it, and I'm going to put it into my problem here, paste it as a bitmap. Yeah. So insert or paste, sorry, home, paste special, bitmap. So there I have the rolling beta for Walmart. And so I have to talk about historical. The historical beta, you can see the median's been about 0.95%. Recently it's been really, really low, down in the 0.4. Part of this is what you expect for firms over time. As they become larger, their betas tend to come closer to 1. I really, history, the median is 0.95, but more recent has been much lower. I still believe my 0.7 is correct, even though a little higher than recent. Very subjective. I can't give you a definitive answer here, but I really believe there's nothing I'm seeing. If I'd seen the entire history above 1, that would have made me nervous. The entire history was below 0.5, that would have made me nervous. The fact that as a small company, Walmart had a higher beta, but now recently, because of there's so much disruptions in the market, and Walmart's actually been one of the firms that's almost benefited from the 2008 and the coronavirus debacles, just these crises, that I can see why their beta would look much lower. But remember, we're trying to find a beta going forward, a beta for what we think is the future for Walmart. So there's my answer. This is what I'm expecting on number 7. It's still an Excel application because you have to pull up this in Excel and you have to do the rolling beta in Excel. I do want you to submit your Excel for your rolling beta just in case there's an issue, and I can send it back to you to fix it. But that's how you do this particular example. Sorry, this video went a little longer, but I wanted to make sure we finished it so you could have your entire Excel application 7 all in one file. Now what we'll do next session might be a little bit shorter, is I'm going to go back and I'm going to finish Excel application 6 for problem 1 that we had started last time, and that'll end it for this particular session, and then you'll have everything you need to finish 2 Excel applications.